Good afternoon, ladies and gentlemen. Thank you so much for joining us. Great to be with you. My name is Eleni Jokos. I'm an anchor and correspondent at CNN, and our conversation is really important. We're going to be focusing on purpose-driven capital, unlocking the trillions that we need for inclusive growth. A huge welcome to my fantastic panel, His Excellency Dr. Sidi Ould, President of the African Development Bank. We've got Yazeed bin Saleh AlYahya, CEO, Saudi Eksab for International Investments Company. Makhtar Diop, the Managing Director of the International Finance Corporation, the IFC. Ilan Goldfein, President, Inter-American Development Bank. And Nikolai Podguzov, Chairman of the Management Board, Eurasian Development Bank. Gentlemen, great to have you with us. And it's such an important conversation because we're so close to missing the Sustainable Development Goals. For me, it really worries me because I've been covering the SDGs for so many years, and it feels like 2030 is after tomorrow. We've run out of time. So Yazeed, I want to start off with you. The world has around $22 trillion in private assets, and yet we talk about this $4 trillion annual gap to fund the SDGs. What is the single biggest barrier, would you say, to stopping capital from reaching some of these very important projects?
Thank you, Eleni. So I believe one of the major barriers for the capital to be reaching to the global south or to those frontier and emerging economies is the financial exclusion. And for far too long, those markets have been overflooded with debt. And I think the missing element to overcome that challenge is mobilizing catalytic capital. I'm sure almost every market from those frontier and emerging economies, they do have great talents, great ideas. If brought to life or mobilized with that strategic capital, there are great outcomes of opportunities to be capitalized on that would create jobs or grow skills or also contribute to the GDP. So I think mobilizing that equity capital besides the debt is one of the major things that can overcome that barrier.
So Sidi, it's great to have you with us. I mean, I've been covering the incredible work that the African Development Bank has been doing over the years. And with you now at the helm, you've got a new vision to unlock some of this capital that exists specifically on the African continent. Take me through what the plan is, because when we look at the deficit for Africa itself, whether it's the infrastructure deficit, I mean, whatever we're looking at, there's a huge deficit, and we need to increase our industrial base overall.
No, thank you very much. So as you know, my 4 cardinal points for the African Development Bank Group start with the point 1, which is about scaling up the financing for Africa, making each dollar works like 10. The second cardinal point is about reforming African financial architecture. If we don't take only the 2, so we have already what we need to bring capital at scale to Africa and to fund the development of the continent and to bridge the gap in terms of infrastructure, but also the gap in terms of achieving SDGs. So if we think about Africa as a whole, if we take African pension fund, African sovereign fund, African central bank's reserves, African insurance and reinsurance industry, we talk about almost 1 trillion of saving or asset under management. So we need really to bring all the African financial institutions to work together.
Do they want to work together?
And this is the meaning of the reforming African financial architecture. We have already started. We had meeting with African Sovereign Fund. We had the meeting also with African Guarantee Funds. And we are very soon meeting African Pension Fund, African Capital Markets, and the African Central Banks.
Okay, what is the response been?
So far, there is a great enthusiasm among all the players to work together. And I think it's big time for Africa to work together to develop its own resources. And then we also can bring FDIs.
I'm almost certain that one of the biggest conversations is how risky the projects are, how risky it is to invest in these projects. So I'm so glad I've got Makhtar with me. You and I have been talking over the years and the incredible work, again, that the IFC does. I want you to tell me about what it's like for you guys to de-risk projects on the African continent and why the perception is still skewed as there's still too much risk, specifically with projects that seem unbankable, and what you guys do to ensure that they are?
So let me bring it a little bit to what we're doing generally, along with Ilan, with Sidi, and other colleagues here. So what we realize is that the capital market needs to have simple, clear information. The information that was available for the capital market to invest in Africa on the emerging market was not really usable and available. So we have built something called the GEMS, which is a database which shows the default rating of credit rate, default credit in a different part of the world and in part of our portfolio. We have gathered information from IDB, from African Development Bank, from the World Bank Group, and now it's available, it's on Bloomberg. So investors can really know the risk which is attached to a particular country. Not speculate on it, but see the real data and make decisions. Secondly, the financial instruments, the size of the investments that are required and the type of a project are too small for the capital market. When you talk to institutional investors, they tell us, below $1 billion, we are not interested. It's too small. We don't want to waste our time underwriting
$1 billion, it's
$1 billion is something that they put as a target. They can go below, but this is an order of magnitude. So what are we doing now? We have developed what we call securitization of our loans, so that we have packed it and put it to the market. And we just had the first issuance a month ago of $500 million. And we will be repeating it. And once again, it's a joint effort between MDBs. We will be taking the assets that are interested for the market, we package it, we securitize them, and we put it on the market, and we can therefore better use our balance sheet. The third thing that we are doing is to say that we need to de-risk investment. Once we have provided all this information to the market, now after we have presented asset classes which are starting to be interesting, how to de-risk investment. So we are doing two things, bringing more guarantees. That's why the unified guarantee platform was created in the World Bank Group by our president, Ajay Banga. And the second thing that we are doing is that we are using money from the philanthropy to be able to de-risk and grant money. For instance, in my conversation with the Saudi authorities, Saudi is providing a lot of grant to countries, and they're more and more thinking about how to use part of this grant money to de-risk private sector investment that will be made in this country so that we can have the impact that we want. So we are moving on different fronts, and all this is done collectively because we realize that we need to be together. We are simplifying our procedure. We are having mutual reliance processes, whereby I can use the process that Ilan is using in IDB Invest, the same with African Development Bank. So when we go to the market, it's much simpler, much faster, much more agile, and we have something that the market can recognize and say, okay, I'm ready to underwrite and put $1 billion. So this is what we are doing, and in our reform, we will need to continue increasing our ability to generate projects, as you say, bankable projects, and this was half of my conversation at FII was to talk about a portfolio that you can build together to be able to originate and distribute.
So actually, before I move on, because I'm hoping we can unlock some money that's maybe sitting in this room, or perhaps the people that are watching the live streaming of this, what are your NPLs, Sidi, at African Development Bank, non-performing loans?
So they are
the percentage?
Very low, around 2.3.
2%? Okay, and your returns?
So the bank is a development bank by definition. So we are not supposed to make profit, but we are really providing financing to the continent and supporting regional bank and supporting the private sector in the continent and achieving the SDGs in the continent. Yeah. But let me tell you something about the risk perception of the African continent. So Africa is perceived as a high-risk continent, but in fact, data shows that the risk-adjusted return in Africa on infrastructure is one of the highest in the world, if not the highest. Second, the default rate in Africa is the lowest, one of the lowest in the world. So there is a risk perception. What we are doing now, what we are doing with the African Guarantee Fund, which I met last week, is to put together an African continental de-risking mechanism, which will provide risk mitigation for foreign direct investment.
Brilliant. Okay, Makhtar, what are your NPLs?
It's the same order of magnitude. We
Same.
are around the 2%. And we have return which are good because, in fact, what we're doing, we're co-financing with the capital market. So if we don't have the rate of return which is interesting for the market, people are not co-financing with us.
So it makes sense.
Sorry?
Take all my money. This makes sense.
Yeah, please, bring it to...
I'll focus on the small projects. Ilan, what are your NPLs?
We are all, this data that Makhtar mentioned, the GEMS, is crucial because it shows that multilateral development banks and other public banks have preferred credit status. What does it mean? That you get the money back much more often and you get less defaults, more performing loans. And this 2% and 2% is the same. That means that the ratings could be higher for us.
Yeah.
And it means that we can lend even more. So independent if it's 2, 2.5, 1.5, the preferred credit status is very important. The GEMS that was just published a week ago is crucial for investors.
So let me ask you this, because what we see in terms of investors here in Riyadh, I mean, they manage trillions of dollars in assets. I mean, we've had some of the richest people in the world here. And I wonder how we get to unlock some of that. And listen, what's happening behind the scenes, guys? Are you signing any deals? Ilan? I see your smile.
I think we need to change our mentality here. We want to bring the money where the projects are. And we kept saying we're going to de-risk. We just don't have enough money to de-risk everything. We need to change the mentality. We need to bring the projects where the money is. What does it mean? We have projects, they are risky. They are in areas that demand some time. What we need to do is to use loans that were originated already, diversify them, and then package them to the trillions that exist that want safe asset, high ratings, with stability for their pensions, for the insurance. We need to do that. We need to bring the projects that are risky to the investors that want unrisk. And we can do it because we can diversify, we can distribute, we can put guarantees, we can verify, and then we can unlock more money because the local banks are already lending some of the projects. We just need to take them out of there.
Okay, Nikolai, I want you to jump in here and tell me about your experience. I mean, are investors just chasing returns, even with what we now dub as purpose-driven capital?
Yeah, thank you very much. Eurasian Development Bank operates mainly in Central Asia. Central Asia is a fast developing economy in general with a rate of above 6%. And definitely it's very important to attract capital into the region. The Eurasian Development Bank NPLs is close to zero. Why? Probably because we start jumping into the project at a very early stage, and we have an opportunity to structure it in the way to make comfortable for everybody, to attract private investors, to attract other MDBs. And that is why I think it's very important to cooperate not only horizontally, but only on vertical level. Because smaller banks know the region better, they can manage local risk, and probably it is better to make collaboration between global banks and regional banks, and it will help to attract more private capital and to attract more investments into the concrete regions.
Okay, brilliant. Yazeed, I want to come to you, and I want to talk about the trust elements, and it keeps coming up. Apart from the perception of risk, we see this report, we've got some data in our hands, and I know that you're sort of in the tech space, so I want you to give me a sense of whether we can adopt, for example, AI models that will track each dollar spent, or a way to sort of track these investments. Because, as Sidi was saying, if you're going to be tapping into savings on the African continent, each country, each bank wants to make sure whatever they put in is 100% safe and secure.
So I believe it's more about international collaboration. So AI sounds very promising and encouraging. But I think whether it's Sidi, Makhtar, or Elin highlighted about the gems. Now, this is very powerful tool. So when we talk about deploying money in those markets, you need to understand that it requires two major things. First of all, your long-term commitment to that investment. The second is a very high risk tolerance. So with this international collaboration, these type of tools where they provide data and the accessibility of this data, this collaboration should help in creating greater impact to those markets, because those markets are scattered everywhere. And for some parts of the world, they need to understand what are the opportunities that are available there. Who can I partner up with from the international players for me to be able to deploy money in those markets? And the condition of that, I understand I'm exposing my portfolio to a high risk, but it also requires a longer commitment. So we shouldn't call up the money or consider it like deploying money in more developed markets where we want returns and quick money back.
Okay. Makhtar, I want you to, yeah.
A word that you just mentioned, which is important, is being here in the long run. And what it means for the private sector investment is to take equity, and not only debt, land, and go. So what we are doing now is that we will be increasing significantly our amount of equity. It means that we're taking more risk because it's a long-term, building a company. But even if we're doing more, we'll be taking now junior tranches. In technical terms, it means that we will be the one at the bottom of the pyramid if you have to be paid back. People who have a senior share will be paid first. So we are taking more risk on our balance sheet. And that will help us strengthen the governance of companies, bring them strategic direction, and therefore be able to generate more of this bankable project. So a big shift is that now equity is becoming much more central in what we're doing, and we show the long-term commitment that we have and the willingness to build those asset classes. A second thing that also is happening is that when we are going now in the process, and I think Ilan has been really a big leader in this, and Sidi now as leader of African Development Bank, is that now we are not thinking anymore as World Bank, as IFC, as IBRD, as IDB Invest. We are coming to countries and try to develop our capacity to generate projects and together to go to the market and offload it together, which makes it much more powerful, because if we don't do that, we will not be able to get the trillion. Last point, which is a more complicated question, is what are the regulations in Basel? The Basel regulation imposed some restriction in terms of investment that I think people have been discussing with. Prime Minister Makhtar was involved in this conversation before, and we want also to start bringing that confidence to the regulators that the assets in which we are investing are assets which are profitable, which are managed and sound assets.
Let me ask you this. I really want to focus on this perception of risk, and it just keeps coming up again. You know, not too long ago, a few months back, we had a downgrade on one of the developmental agencies in the Global South. And if you dig through the numbers, you know, if you look at experts that understand the continent, would have a very different perception of what Moody's, Fitch, or an S&P think and feel about things. Sidi, I want you to give me an understanding of what's happening behind the scenes, because many years ago, I remember we were saying, you know, we need to create a Global South credit rating agency that understands the perception of risk or the risk dynamics on the African continent in particular. How are you navigating this?
No, this is a very important question, because it has also a direct relationship with the cost of borrowing in Africa.
Yeah, because it's still very expensive.
Too expensive. Yeah. And at the African Development Bank, we are working now to bring all the African DFIs to work together, and also to support our countries in the rating process, to get our countries better prepared for rating, but also to engage with rating agency to let them understand what is the reality of risk in Africa, what is risk perception, and what is risk reality.
Do you think it's mispriced,
so
the risk in Africa?
Definitely, the African risk is mispriced, and the rating agencies have to understand the risk, the reality of the risk in Africa. And we intend at the African Development Bank to engage a dialogue with rating agency, bringing all the African DFIs, but also supporting our African member countries in their rating process, supporting our African DFIs in their rating process, and installing a dialogue with rating agency to let them understand the reality of risk in Africa, and based on data like the GEMS, we will really be able to convince them to have a different view of the risk in Africa.
All right, we only have a few minutes left, and I have one important question, because there's a $4 trillion gap every year that we're seeing, and it's just compounded. I mean, we're going to miss the SDGs. We're not hitting them. So we've got to be honest with ourselves. So Nikolai, let's start with you. Very quickly, what do you think needs to happen to close the $4 trillion gap?
First of all, I think we need to elaborate instruments to raise MDB's capital at least 2 times, to double it. I think World Bank Group has proposals here, and I think we need to follow them. And second, cooperation to attract private capital to the project activity. I think it is all possible.
Ilan.
As you mentioned, the money is there, trillions.
Yeah.
You need to be able to attract this money to the project. We have limited public sector money, so we need to use it very smart. Put equity when you need it. When you want to de-risk, you actually re-risk. We shift the money so that we can attract more private capital. And that is very important. You originate, you distribute. You put equity where you need. You don't have enough money to scale from public sector, from taxpayer money. So private sector, get the risk correct, and then you can scale.
If I see the balance sheet of the world, we have enough money.
I am totally in agreement with what you said. We need really to shift the conversation.
Yeah.
There is country are indebted, country has a lot of challenge at the public side. Since the private sector, we will create growth and create jobs which are decent in countries. So today, we need to do everything to bring the project, the condition, and look at the conditions that are needed for the private sector to come and invest. And it's not impossible. It's not impossible. Let me take 2 minutes to say it's not impossible. 25 years ago, I was on the side of the table. We were the first one to have a sovereign rating in Africa besides South Africa. When I did it for my country, people were saying it's impossible, it's crazy. You see today, it has been done, people have been issuing. That's the same that we want to do with the private sector. People are telling the private sector in these countries is too risky, you cannot use the same instrument. We need to take the instrument of the market and use them to attract money and bring it in emerging markets. There is no other solution. The market understands certain things we need to bring to go to the market and not expect that the market will work to countries.
Yazeed.
Well, I think, to be honest, I re-emphasize on the word, and I would like to quote Ilan when he said, there are opportunities, but the money element is the missing one. And I think this linkage or this gap between the private sector or the opportunities out there is crucial to do that linkage. It's also very important with the title of this session. It is important to consider having purpose a major driver in your investment decision making as well, for you to be able to achieve your returns and that socioeconomic impact that you want to generate in that community.
I'm so glad you mentioned that. The purpose is not just for returns, but also impacts. And I think sometimes we forget that. At least the investors do, right?
So African Development Bank is about impact.
Yes.
And our convening role and convening power will enable us to help our countries to attract more foreign direct investment and more capital to the continent. And we have to work on many fronts. So we're working on the balance sheet optimization of AFDB, like other MDBs, but also de-risking private investment and supporting our member countries to develop their legal, institutional, and regulatory framework to give the confidence for the investor that their investment in Africa are safe, and they will be safe. Africa is the best place to invest in.
I agree with that. Round of applause, ladies and gentlemen, for my fantastic panel.
Thank you.
Africa is the best and safest place to invest. Fantastic. Thank you so much.
Thank you so much.